Let's talk about the market today because, again, it was a little bit about the Trump-Kim meeting. Started out this morning, markets opened up, but the markets kind of figured out pretty quickly that this agreement with North Korea really wasn't much more than just an agreement to have more meetings. And they kind of disappointed the markets that were looking for more substance out of it. Markets sold off this afternoon, actually went negative late this afternoon. Did get a bounce right at the end of the day, some repositioning in portfolios. And again, as we've talked about here for a while, what the market is really trying to do here, most importantly, is really just trying to consolidate here this recent breakout. We talked about this consolidation process. We then broke out. The market's been holding on to that very well for the last couple of days. Now, importantly, though, in the real short term, the market's gotten very overbought. After this long drawdown that we saw earlier this year, the markets have made kind of two advances at this point, which is they haven't gone a great distance, but it's used up a lot of the fuel that had been stored from this oversold condition that had occurred in the markets previously. We're now back to overbought. Again, that just kind of limits the upside. And more importantly, what you're watching right now is there's multiple levels of resistance that are currently clustered right here between 2780 and 2700. And the market's bumping up into this and really having a bit of difficulty getting above this. Now, if the markets can hang in here and then break out to the upside, we will get a move to old highs. That is pretty much baked in the cake if that occurs. One of the things I kind of suspect is going to happen that there's enough stuff going on this week. We've got the Federal Reserve tomorrow. We've got the UK with the Brexit. Theresa May kind of lost a vote today on that. That's going to make Brexit a little bit more difficult at this point. Italy's still out there. Even though Italy's made some comments about wanting to stay in the EU, their debt crisis is still a major problem. Deutsche Bank's still a problem. A lot of these issues, investor confidence in Germany just fell to lows that we haven't seen in quite some time. So there's a real dichotomy between global growth, domestic growth, and kind of what's going on currently. So there's a bit of risk here in the markets. It could disappoint stocks in the near term. And as long as we can hold above this recent support of that consolidation, which is right at the 100-day moving average, the market should be okay. And we should see the markets be able to kind of muster up in advance here. And again, once again, move higher. But again, we're a bit early. We're moving into summer, which typically tends to be weak anyway. So while we've talked about recently adding exposure, which we have, we are looking to add further exposure, but we'd like to do it on a bit of a pullback here. So we're not getting overly aggressive here. We're still holding a little bit of cash, but on a pullback here that gets us a better entry opportunity, we will certainly add some more exposure as long as, and again, most importantly, we don't break any major levels of support. If we break support, game changes, and we've got to take different actions in portfolios. So really keep a watch on our newsletter as well as our Technically Speaking Tuesday update. Both of those, we go through our positioning and talk specifically about what we're doing with our portfolios and with our money, so you can kind of follow along and play that game. Outside of that, the one other issue I want to talk about here real quick with you is really looking at bonds. Despite the fact that the market's going up and everything seems to be a whole lot better, bonds are actually still holding up here very well. And we saw this recent bottom actually begin to put into place, and we've actually seen some improvement in money flows into fixed income over the last few days. Two big treasury auctions this week have gone off without a hitch. Plenty of buyers have showed up. Interest rates really haven't moved much at all. We still stuck between 2.9 and 3. If there was real concern about sharply rising inflation, sharply rising interest rates, I think we'd see a lot less action and a lot less demand for bonds than we're currently seeing right now. So despite all the rhetoric that 10-year treasury rates are going to go to 5% or 6% or whatever, the reality is that we are likely forming a bottom in bonds right now. And probably within the next 12 to 18 months, I think this is going to wind up having been one of the better buying opportunities for fixed income that we're going to see over the next few years. That'll also coincide with the onset of a recession, which, again, very likely we're going to see sometime late this year, early next year. The one thing that we're watching very closely here, and the one thing that you've got to really pay attention to, is the interplay between what's happening with the dollar, interest rates, oil prices, etc., because these are all acting in a manner that normally have not been good for economic outcomes. So pay attention to this closely. We're going to keep a watch on it very closely for you. We'll be reporting on it as well. When we come back from the break, what time's Dr. Brody coming in?
He'll be the bottom of the hour.
Bottom of the hour?
Yeah, and one thing too interesting today, the rotation into the food and beverage stocks, which I thought was amazing. Underneath the surface, we're seeing a little bit move back into defensive sectors when it comes to the stock market. And as we know, staples have not been the place to be.
Exactly. Well, not just staples. Look, you had a huge move today in utilities. They were up 56 cents today. And look at where your actual activity was. If you take a look at activity in the markets today, it actually occurred in all the defensive sectors. Real estate, utilities, consumer discretionary did okay. Staples did well. So again, the areas that you would expect to do poorly in a strongly rising market, actually the ones catching money flows. So that also tells another story as well.